So I appreciate everyone joining here today. We're going to get started here in about a minute. There is a lot I want to get into today. Firstly, there's some headlines that I want to go over from a tax, accounting, and regulatory standpoint related to digital assets that I think is very pertinent and will help you whether you're a digital asset investor, Web3 CEO, or CFO. Then I want to go over a couple things that I'm seeing in my practice and discuss that in detail as well. So I'll give everyone here a little bit longer to come in, and I'll just check something here on my end, and then we're going to get right into the headlines here. Let me check one thing, and okay, I think we're good. So let me share my screen here, and we'll start to get into some of the details here. So firstly, this just went live yesterday. This is me and Rich Pasqua, who owns Web3 on Pact. We did a talk that was filmed earlier this week, and he just posted it yesterday. We talked about a lot of relevant tax and accounting topics, really at a high level. And we went into some really interesting topics, some things that I'm seeing sort of across the board this year, issues with new incoming clients and just issues that I'm seeing within my practice. So we went over a lot of those details here. Rich asked great questions. We're going to be doing a series on this, so there'll be more talk shortly, but go over to Rich's YouTube channel and give this a listen and check this out. And I believe, there'll be a lot of value in there for you, whether you're in Web3 as a business owner or as a digital asset investor, or if you have your own practice as a CPA or as a CFO. There's a lot of value in here. So I encourage you to check that out. Additionally, we just had another another edition of our digital asset digest go live this week. It goes straight to your inbox every Tuesday. If you sign up on our website here at camusocpa.com, you'll basically go down to this section, enter in your name and email, and just let me know a little bit about yourself in terms of, are you an investor, a business owner, artist, consultant, and then that will get you on the list, and we'll send you the latest updates, the most relevant tax and accounting news in the Web3 space to your inbox every week on Tuesday. Also, this newsletter is also live across LinkedIn. So on LinkedIn, the newsletter goes live on Thursday. So depending on exactly where you want to sign up, you'll be able to gain access to that. Next is on November 3rd, and I'm giving some time to plan this one ahead. I just launched this, but what I'll be doing is what I'm calling a crypto CPA Q&A. So I'm gonna make a post, pin it onto my LinkedIn profile, where if you have a tax question or an accounting question that comes up that you're looking to get some insights on, you can go ahead and basically post your question right there, and I'll be compiling these questions over the next couple months. And then I'm going to take maybe the top 5 to 10 questions. And during this LinkedIn audio event, I'm going to go into those questions in detail and respond to them. And then during that event, I'll welcome other people to ask questions live during the event as well, so I can clarify any specific topics during that event. So keep an eye out for this. I just launched this, so there's not a lot of attendees signed up yet, but I'm sure people will be, filling into this over the next couple of weeks, and you'll certainly see me posting more about this in the weeks to come. So those are just a couple things I wanted to point out that I've been working on, that I will be working on, and that I think may interest you. So now let's get into some headlines. So first is, there's always scams that we need to watch out for. As a CPA and a CPA firm owner, a lot of times I'll have people reach out to me and ask me about some of these scams. So I it's not my main focus, but I do see a lot of these issues when I'm working with clients. This one is pretty common. So FBI warns of increasing cryptocurrency recovery scams. So you may have seen these people where they'll make you'll see like random social media posts, usually in the comments, just saying like, oh, so and so really helped me. They're a legitimate recovery expert. They have the best cyber skills. They helped me find my lost crypto. The whole point of what they're doing is trying to basically say like, this person is a asset recovery expert, and if you lost your crypto, they can basically recover it for you. Then what this scam goes on to do is the FBI explains that these recovery schemes aim to deceive individuals by bearing the expenses of the purported recovery in advance. So basically, they'll say, hey, we can help you recover your funds. We've successfully done this in the past with several people. You need to pay us a deposit. You need to pay us a upfront fee, and then we'll recover the funds for you. Obviously, what happens after that is they don't return the funds, and basically these people that fall for this, they already lost their crypto and then they get scammed again, unfortunately. So this is something to be aware of and something you definitely want to avoid. And it's something that is becoming so common that even it's the FBI is starting to warn about it. So this is something that you want to be aware of, and you want to also be making your clients aware of. Next, I was really happy when I saw this. IRS halts most unannounced collection employee visits to taxpayers. So what does that mean? In the past, if you owed the IRS money, many times they would send tax notices, but in some cases they can actually send out an agent to go knock on your door at your private home, and to basically start the tax collection process, ask you certain questions, give you next steps. So obviously no one really likes people showing up to their home unannounced, particularly if it's going to be an IRS agent or some other government official. And then on top of that, they're probably looking for money that you owe them. So um, this was a common practice that, as you see in this article, for decades, IRS ROs have visited households and businesses as part of their efforts to collect on federal tax liabilities. So this is going to be putting to a stop for the most part. They're not going to be coming to your house anymore. So IRS Commissioner Danny Werfel stated, "We are taking a fresh look at how the IRS operates to better serve taxpayers in the nation, and making this change is a common sense step." So here's part of the reason why they did this. He noted that there have been increased security concerns on multiple fronts. The growth in scam artists bombarding taxpayers has increased the confusion. So many people are aware of the scams where these call centers will call in, act like they're IRS representatives, prey on people that maybe don't have their full wits about them, and get them to pay them money over a phone scam. So something similar like that can be done, where someone can come up, act like an IRS agent, and start to try to extract funds from people. So there's a lot of risk in terms of scams there, and that's another reason why I'm just happy to see this go away. So in place of this, what are they going to be doing? They'll be sending out tax notices. So they still say that unannounced visits will still occur in extremely limited situations, where they must serve a summons or a subpoena, or where sensitive enforcement activities involving seizure of assets are planned. So they will see that these types of situations will be less than a few hundred per year, a small fraction to the tens of thousands of unannounced visits that they were doing to people's homes before this. So overall, this is good. Regardless, if you're a taxpayer and you get contacted by the phone, you get contacted in person, or even if you do get a tax notice, your very first step should be contacting a trusted tax professional that you work with, and allow them to review the tax notice or explain to them the nature of the conversation that you had, and then work with them to determine what your next best steps are. Is this legitimate, and what should you do to remedy this situation? Usually next steps are going to be you contacting the IRS in some form. So just keep this in mind. And overall, I'm glad to see that there will be less unannounced visits going forward. So another headline that I wanted to cover here. So this is an article in Accounting Today by Chris Katana. And this is quite a lengthy article because he went into great detail on it. And I encourage everyone to read it. It's a great article. Chris does a great job of covering the Web3 digital asset space from an accounting and tax perspective. He's on top of a lot of the topics here. And in this article, he really did a broad overview on what are some of the challenges for tax and accounting professionals in serving their clients in this space. So I'm featured in this article along with many other great professionals. So there is a lot of different perspectives that go into this article, which is why I think it's a good read. One of the major things that I focused on, there's a couple things I focused on in this article. One major thing is, and you may hear me speaking a lot about this, is tracking your cost basis appropriately. This right now is just somehow still a huge issue for individual investors as well as businesses. And if you're not appropriately tracking your cost basis, it's going to create several different issues for you, both potentially in the current tax year as well as future tax years. So that's one thing that I really harped on here, is basically that we need to make sure that we're appropriately tracking cost basis on a cumulative basis, and that we're doing due diligence on that each accounting period to make sure that that's accurate, so we're confident in the current year as well as future years. So this is a big one to keep in mind. That was one thing I hit on. Again, there's a lot of details in this article. I'm not going to go over all of them just because we're not going to have time for it. I want to sort of hit on the big parts that I mentioned in the article, of course. Another thing I hit on in here down in the tax section, I'm just looking for it, would be NFT taxes. So we discussed about the look through rules that we're going to see with NFT taxation, and that there's still a lot that needs to be clarified there from a tax perspective. So that's currently an area that we're watching very closely. And also NFT sales taxes. Obviously, this is a big emerging tax issue that currently is to a very large degree is going overlooked, that I anticipate to be a huge issue in the future that we're currently working very hard with clients to address. So we also hit on that as well. Some of the potential issues with NFT sales taxes, how to get into compliance with that, some of the risks associated with retroactive taxes for NFT sellers that haven't collected taxes on past NFT sales. So there's a lot in this article, and I'm really only touching the surface of some of the points that I raised in it. I really think this is a good article, so definitely check it out over at Accounting Today. This in international tax news I thought was interesting. Japan's blockchain group lobbies for tax changes. Now, I'm not an expert when it comes to Japan's tax laws. I do have a basic understanding. They're fairly the taxation structure for digital assets and cryptos in Japan is pretty aggressive, meaning that they're not really offering a tax environment that's going to really facilitate a lot of growth within the industry. They have unrealized gains that get applied to cryptos. They have fairly high tax rates for trading cryptos, and a lot of these things right now they're lobbying to start to really change substantially. So let's see here. So the first change would be to abolish the year-end unrealized gains tax on corporations holding crypto assets, which refers to the profits that occur on paper but are not realized through the transaction. So that right there can be, a huge incentive to see more companies within Japan want to hold these assets, because because they're removing that tax. So they're also looking at lowering the tax rate that's applied at the personal level when people are trading crypto. So also eradicating income tax on profits generated through individual crypto transactions. So there's just a lot of very favorable and positive tax changes that we're seeing cited in this article that they're lobbying for and potentially looking to implement in Japan. So I think that's just interesting from a global perspective. I try to watch what's going on with regulators across the world when it comes to crypto taxation to see the different approaches that they take, to see if some of those approaches may be used here in the future, and also how they impact international businesses and clients as well. So I thought this was interesting. Um, so the biggest news of the past 2 weeks is the crypto staking guidance. So I've written up my analysis of this, and if you go to camusocpa.com, the name of the article is Navigating the Crypto Tax Waters, a comprehensive analysis of revenue ruling 2023-14. So I go into my details and my perspective related to this staking guidance. For me and for my firm, it doesn't come as a surprise that staking rewards are going to be taxable upon receipt. That was our position with clients that were filing with us. And again, it doesn't come as a surprise, although I do understand the argument against taxing the rewards upon receipt. I just didn't anticipate that was going to be the IRS's position, and it turns out that that was accurate. So this is a perfect example of, there's probably a ton of people now that reported this correctly on their return, and there's a ton of people that took a more aggressive position and reported it incorrectly on their return. And now they're going to be left with this issue of, are they going to amend their returns, or how are they going to address this from a compliance perspective? And I think this highlights the fact that a lot of people will say, oh, there's so many gray areas in crypto, like that's a good thing. Like that somehow is going to benefit you as the taxpayer, that there's gray areas. And this is an example of where it doesn't benefit you. In scenarios like this, it's usually going to be better. And we always have to look at the specific facts and circumstances. But in most cases, it's going to be better to take a more conservative position. And you're usually going to be better off as a taxpayer if we have clear standards to follow in terms of the taxability of a specific transaction, rather than having to interpret different areas of the tax code that may or may not be applied to your transaction. So again, section 61A of the Internal Revenue Code defines gross income as encompassing income from all sources. So we have legal precedent such as Coons and Rooney that basically is going to say that these staking rewards are taxable upon receipt, and that's the position that the IRS took. Now, what a lot of others are arguing, and this will continue to be argued into the future as well, is that there's no clear counterparty that's paying out the rewards. It's got no pre-existing owner, and earning staking rewards is more akin to crops being harvested or minerals being extracted. And if that was the case, they wouldn't be taxed until they were sold in the future. Obviously, this isn't based off of this revenue ruling. This isn't the IRS position currently. So there's still a lot that we need to watch here. There's still going to be more follow-up guidance related to this revenue ruling. And this was also only for cash basis taxpayers. So, we need to look at transactions fees, Section 83, accrual method, some of the foreign tax implications associated with this. So there's going to be a lot to follow up on regarding this, but it sort of clears this debate that, the IRS is not looking at you gaining rewards from staking activities to the same thing as you harvesting a crop. And this has very large tax implications, because if you're getting staking rewards in an asset for the year, and you're earning income based off of the fair market value, and you decide to hold these assets and expose yourself to the validity risk of that, you're still going to be taxed based off of the fair market value. Now, those assets may drop by 50%, let's say, and then you sell them at a loss. All your income is going to be taxed. Your capital losses are going to be limited against your ordinary income. So, this has been a scenario that I've seen quite frequently, where people are earning staking rewards in a smaller cap asset, and they, rather than just getting their rewards, selling it immediately, they're looking at this more of, they want to earn their rewards, and then they want to take on some validity and see if these assets appreciate. If they decrease, now you're left with a high level of income and a capital loss that you can't use against the income. So it can put you in a fairly bad tax position. So you need to be aware of this, just in terms of making sure that you manage your capital appropriately. And also, at the very least, when you're earning these staking rewards and they're going to be taxable, you need to consider your principal investment, but you also need to consider that you're triggering tax liability. So at the very least, what I would do is, at least consider when you're earning rewards to at least liquidate what you're going to owe in your tax liability, so you're not exposing your tax payments to validity risk. I've seen during each cycle of this industry over the years, people either earn in an asset or they'll take profits into an asset from a smaller asset. Then the market drops, they're planning to pay their taxes out of that, and they just end up sometimes doubling the tax liability they have to pay. Because if you're paying your tax liability out of a specific crypto asset and it drops by 50%, you basically have just doubled the amount of taxes that you have to pay. And that is the opposite of any effective tax planning. It can really blow up your portfolio, and it can blow up your business. And usually when people realize this, it's during a bear market, which is not a good time to have new cash flow issues. So this is going to be an area that we need to keep watching, and that you as a taxpayer need to make sure that you're on the right side of this currently. So go to my website if you want to read this whole article. There's a lot of technical details in here that I'm not going to dig into fully, just because it's out of the scope of this video, but there's a lot of interesting points that I made in here. And we do have the Loomis-Gillibrand bill that may end up changing how the taxes get applied here, but again, that hasn't been passed yet, so we can't rely on that, and it's still questionable if it will get passed. So that's my take on this revenue ruling, until we start to gain more details from it in the future here. So another thing I wanted to hit on, this was a post I made a couple weeks ago on LinkedIn. You may have seen it. It's pretty lengthy, but it sort of lists some of the issues that I've been seeing within the industry, just in my client intake process, in my hiring process, and just in my consulting process in general. Seeing many issues over and over again. Some of them I delineated here. So, I basically started out just by briefly describing my journey and struggle in becoming a crypto CPA during the early days, and a lot of the ambiguity in this space back then. And then I go on to say some of these issues. So this is the first issue. Firstly, new clients come to me with years of work that needs to be redone due to sheer negligence of other well-established firms. So this keeps happening, where I'll have clients come to me and they may have been working with another firm to get years of their accounting completed, and then they'll bring it to me. And just on a basic cursory review, I can tell there's been no due diligence done. There's just glaring inaccuracies in it. And many times we're left having to go in and fix this, or sometimes it's just there's so many issues with it that it's better for us to just start from scratch and get a good set of accounting, get a good cumulative cost basis calculated. So, I'm not sure how this can happen. Like basic due diligence steps, such as just reviewing ending cost basis data, reviewing the pricing applied to the assets that are being traded by the client, clearing basic variances in the gain or loss, where maybe someone has a zero cost basis, or there could be a variety of issues, but very simple issues that are just going overlooked, where sometimes it basically looks like the person's wallets were plugged into a software, a report was outputted, given back to them. So that's the first issue I'm seeing. And many of these clients will pay substantial sorry many of these clients will pay substantial fees and commit to a lot of work to do with these firms, and they just basically don't get the results at all. Another thing that I'm seeing a lot is that a lot of clients will sign up to work with a firm on an hourly basis. They'll scope the work for them, and they'll say, let's start with 20 hours, 40 hours. And then, basically the client will start working with them, and then the 20 hours or whatever they chose is up, and the work isn't close to completed. And, they start to say, well, we're having these data issues and all these issues. And then this client really gets to the point where they just don't even know what fee they're going to be paying to get the work done. And it's just this open-ended thing that just drags on, and sometimes it bleeds them dry. And then that could get compounded with the fact that then they get the work and it's not even basically done correctly. So at Camuso CPA, we take a lot more time in reviewing your fact pattern up front. And the goal of that is so we can scope the work and we can really see what is it going to take to handle your accounting. Of course, we can't 100% know, because there is a lot of open-endedness to the reconciliation and to the quality of data that we get. But we put a lot of time into our client intake to make sure that we can assess what needs to be done from an accounting perspective. And we've done this for hundreds of people. So, we can fairly quickly do an assessment for you, and we price our work up front based off of our review, so everyone knows what they're getting into up front. And in terms of this issue with negligence and lack of due diligence that we're seeing, it's very important that if you're assessing working with a CPA firm or a CFO, that you really dig into their accounting process, their understanding of digital assets in general, and their ability to really understand the protocols that you're working on, understand your business, and be able to track and trace transactions through the blockchain. You don't want to work with a firm or a CPA that's basically just taking your data and trying to plug and play with one of these softwares, because we need these softwares to facilitate what we're doing, but they're not going to give you 100% perfect output. There's always going to be transactions that are not correct from a tax or accounting perspective, whether they're DeFi transactions that are more complex and the data is not getting pulled over appropriately, or they're NFT transactions where they're not being classified appropriately, or the right pricing methodology isn't being applied to it. It can be a variety of things, but there's always going to be transactions that need to be investigated further, need to be tracked and traced via the block explorers, and then updated from a tax and accounting perspective. And then you need to be doing the right due diligence steps once you have your accounting records complete. So you really want to dig deeply into this process when you're assessing a firm. So that's very important. So then this sort of brings me to my next point is we're on somewhat of a hiring spree right now. So also, if you are a crypto accountant or you are a tax preparer, we are actively hiring and interviewing right now. So if you or anyone else is interested, in a role at Camuso CPA, reach out to me and I'd be happy to schedule an interview with you and we can speak further about that. But this is something I'm doing a lot right now, is interviewing people. Over this last 2 months, I've probably done maybe like 20 interviews or so. So a decent amount, and we're continuing to do interviews. So, there's a lot of great people that I've interviewed. In fact, most people that I interviewed were great. Some of them are also great accountants, and some of them, really have some gaps in their skill set. I was very surprised to see that some crypto accountants that I was interviewing from some pretty well-established firms lacked some really important skills or had some, gaps in their skill set, where if we put transactions in front of you from the Block Explorer as a crypto accountant, I believe you should be able to read them, because how else are you going to interpret what's happening for your client's transactions unless you're just blindly relying on the tax software, which may or may not be accurate? So that, I think, speaks to that there is still a knowledge gap for many accountants, and many of these accountants may even be getting trained by other accountants that also have that knowledge gap. So then it basically perpetuates itself. So that's another issue I'm seeing, that this issue here sort of speaks to why I'm seeing this first issue here, I think. So I do think that they're connected. And then it goes on from there. So another thing, when I'm taking in new clients who have gotten previous work done, the first thing I need to ask them is, well, let's see the deliverables that you've received, either from your CPA firm, or if you self-manage this, from whatever accounting software you used. So then we can run into very big roadblocks there as well. So basically, a lot of times both firms, so let's take it first with the softwares. Some softwares will give you all of your data, but some taxpayers will just neglect to download it, and then they're basically leaving all of their data on these softwares, and that can cause issues in the future because you want to save that in your permanent documentation. So that's one issue I see with people with the softwares. Another is some softwares don't provide a detailed ending closing position report with tax lots at the transactional level with audit trails. If you don't have that, it's going to be very cumbersome to roll your accounting over into a new accounting system if need be. Really, if you don't have that detailed ending closing positions, you're basically going to have to upload all of your raw transactions and rework them into a different accounting system, which is going to be much more administratively burdensome than if you can roll over your ending cost basis that's already been calculated. But I am seeing many softwares not include that data. So there's these two issues of, if you're using a software, you need to make sure up front that you're going to get the reporting that you need from them before you start to commit hours and hours and hours of work into the software. And then once you do decide on a software, you need to make sure that once you're done, you're pulling all of that data out of the software, saving it in your permanent tax record. So you don't want to get held hostage by one of these softwares because you forget to save your data from them, or they don't provide you the data that you need in terms of their reporting. And then basically, I'm seeing this issue transfer over into people that are working with CPA firms or accountants, where, again, they're not getting the data. I'll ask them, do you have a consolidated list of all of your transactions that went into the calculation? Sometimes it was never provided to them. Do you have a detailed closing position report with tax lots and audit trail? Many times this isn't getting provided. Then even if there is some reporting getting provided, I'll get some of it sometimes. And then it goes back to just point one, where there's just these glaring issues in the accounting itself. So, sometimes clients are getting the data and it's just inaccurate. Sometimes they're not even getting the data. And, it's just a huge issue. And, I don't think it's good that firms are doing this. It's going to sort of, paint us in a bad light. And this is already in an industry where there's a lot of ambiguity, and, people have a lot of work to do in order to get into compliance. So, it's just something that needs to get fixed, I believe. But, as the taxpayer, there's a certain level of care and due diligence that I believe is required on your level as well, because you're the taxpayer. The buck sort of stops with you. You're going to be on the hook for maintaining your documentation and for paying your taxes. So you need to make sure that you're doing your due diligence when you're assessing your CPA firm. Then when they're providing you the deliverables, you need to make sure that you're doing your due diligence to ensure that accuracy on that, and then that you're maintaining all of that in your long-term documentation. So, these are very important points. And another one is just the extremely aggressive tax positions that are being taken by some firms. So there's scenarios where I'll see positions that get taken that I don't agree with, where sometimes I think they're just being very aggressive because there is lack of guidance in some regards, and they take a very aggressive approach for whatever reason. Obviously, it's something that maybe clients are pushing for. Other times, there's very aggressive tax positions that are getting taken by taxpayers, where it may be because they're getting advised by someone that doesn't fully understand the protocol or just the overall nature of the specific transaction. So you really have to watch out for this. A common denominator that I'll see when I'm speaking to someone and they've sort of taken a weird tax position and they were advised on it, when their CPA advises them on it, they're usually not gonna really give you the lay of the land and a clear explanation of, here's what's going on with your transaction. Here's the tax code sections that could potentially apply. And here's the conservative position that you should take regarding this. Here's a more aggressive position that some people are taking on this. Here's what I recommend for these reasons. That's how I really like to lay things out to clients, because then you get the full lay of the land. You understand what's going on with your transaction. How does it relate to the tax code? What are the gray areas? What's the conservative position? What's the aggressive position? Usually when I lay this out to my clients, they want to take the right approach. They want to take a more conservative approach and protect their assets. But oftentimes, you want to be wary if you're basically just have a complex, ambiguous transaction for tax purposes, and your advisor just says, oh, it's taxed like this, do it this way. Because then, there's been a lot of assumptions on their end that haven't been relayed to you, and you're not getting put in the position as the taxpayer to make the best decision possible. So, these are some of the issues that I'm seeing. This is a huge area. There's huge needs here. So there's going to be a lot of professionals looking to serve this space. So you just want to be aware of these issues, and you want to make sure that you're doing your due diligence. So I wanted to hit on that because I do think that that's really relevant, and it can really help people out there when they're assessing firms and they're assessing CPAs and they're assessing accountants this year. So those were some of the things that I wanted to go over today. We will be going live next Thursday again, so I'll be posting that event here on LinkedIn soon. Be sure to sign up for that. Be sure to sign up for the Digital Asset Digest newsletter. We just had another edition of that go live today to our LinkedIn subscribers. And if you have any questions or comments about this presentation, or if there's something specific that you want to see me discuss, shoot me a message or drop me a comment, and I'm happy to take it under consideration because I'm looking to deliver as much value here as possible. So I appreciate everybody watching. Until next time, I'm Patrick Camuso, signing off.